United Airlines says that more expensive jet fuel and war in the Middle East will weigh on profits. Right now, that stock is off by more than 5%. Phil LeBeau joins us with a special guest. Phil?
Morning, Becky. Scott Kirby, CEO of United Airlines. Let's talk about Q4.
Yeah.
Your guidance, Q3, yes, you beat the street. But Q4, your guidance is coming in lower than expected, higher costs. What's the issue here?
Well, there's two issues, really. Higher fuel costs. Fuel's gone up a lot, particularly since the war.
But even excluding fuel.
And the other issue, there is cost pressure everywhere in the industry, including at United. Really two things driving that across the entire industry. One is much higher labor costs than any of us expected at the start of the year. And the second one is all the supply chain challenges, which are impacting everyone. It's aircraft, it's engines, it's spare parts, it's air traffic control. And just for a simple example, this quarter we're taking 15 fewer aircraft deliveries than we were expecting. Well, when you're expecting those aircraft, you hire employees. We've got the expenses associated with those airplanes, but aren't producing the capacity yet. And so as long as these supply chain challenges exist, it just drives continued cost pressure at all airlines.
Speaking of capacity, how much is the overcapacity, especially on the lower end, with the low-margin carriers, the low-cost carriers, how much is that distorting the market overall?
Well, look, I wouldn't describe it as overcapacity, but to me, the most remarkable statistic this quarter for the airline industry is probably that United Airlines and one other airline in the country, out of 10 publicly traded airlines, 2 airlines are going to account for 98% of the revenue growth this quarter and over 90% of the total pre-tax profitability. I think there is a seismic shift in the structure of the airline industry, and that leaves us really excited about the future. This seismic shift is changing, where there's a couple of airlines with good, diversified revenue business models that are really succeeding, and that's putting a lot of pressure on everyone else.
So what happens with those other airlines, those low-cost airlines?
Well, look, I think, with United doing what we're doing, we provide a great product to customers. It's a much better product. Now that we're putting seats in the market, we're able to accommodate that demand. And the other thing that we've done is with product segmentation, we've got basic economy working well all the way up to Polaris. We have revenue diversity that can accommodate all the customers. It puts a lot of pressure on them.
But within the industry, I hear from other executives who are saying, look, something has to change here because you cannot add as much capacity as we've seen on the lower end without something eventually breaking.
Oh, well, it's already broken. I mean, look, we're 2 airlines that are 98% of the revenue growth are going to be about 11% profit margins, and we're 15 to 25 margin points, not basis points, margin points ahead of the low-cost guys. It has broken on the low end. It's just a matter of time. They have to change. They have to change significantly, in my view, to survive. And that is already happening. And I don't know the exact timing, but that's on its way to happening.
I know Joe's got a couple of questions. Joe, go ahead.
I just tried, and I think Becky does too. I think we're trying to figure it out. Scott, it almost sounds like it's labor costs, which are we heard about Tel Aviv, and you are the biggest carrier, I think, to Israel. And I'm trying to understand that. So capacity goes down when you're not flying there, and maybe some other places, and therefore your fixed costs are a bigger percentage when you have less capacity paying for generating revenue. But I really think and fuel costs, those are always all over the place. But it really sounds like you're saying that labor costs across the board are much higher. And I look at your stock price, and something's going on there that we didn't understand.
Yeah, so look, on all that, first, Israel is a big impact, but it's transitory. Essentially, it's 2% of our capacity. We have most of those costs that are fixed and set in the short term, but they're not set over the medium term. Presumably, we'll be flying to Israel again. And if we weren't going to fly to Israel, we'd fly the airplanes to other places. So that's a transitory issue. Labor costs are higher across the board in the industry, but we're able, at United, we have been able to pass that on to the consumer. If you just take one step back, yes, it's not reflected in our stock price yet. We're trading at 4 times our earnings for this year. But we also, if you went back to the start of the year, we're going to wind up this year, even with everything that's happened with Israel and with higher fuel prices spiking here in the fourth quarter, we're going to earn double what the consensus was at the start of the year. And we look at this and say, the world is developing almost exactly like we thought it would for aviation, both for United and for the rest of the industry. And that development, frankly, the stress that's happening at the low end of the industry is going to lead to changes in the industry and a restructuring that's going to leave us at a much better, sustainable, much more structurally profitable industry.
Meaning you think those low-cost carriers are going to have to raise costs, Scott? I mean, I'm trying to follow what you were saying. You think it's broken at the low end, they're going to have to raise costs, and that means more profit for the rest of you?
Well, I think that consumers have voted, and as long as United has seats in the market, people are not going to fly a Frontier or Spirit. I think they have to change the business model to make it attractive for customers, or they're going to go out of business.
Scott, in terms of the consumer overall, close-in bookings were stronger in August and September. Are you seeing any slowdown in the consumer at all?
No, at United, we're not. Demand is strong and steady, second quarter to third quarter to fourth quarter. Again, it's a little different at United. There's 2 airlines that are 98% of the revenue growth. If you're one of the 8 airlines that are trying to share 2% of the revenue growth, it may feel a little different. But at United, it's strong and steady.